If growth was going to be 1.5%, this would take it up to 3%. That's a huge number. Well, this is Grover Norquist, and welcome to Leave Us Alone, the podcast that champions individual freedom and limited government. And today we're going to be talking about the big, beautiful bill, the Tax Cut Spending Reduction Act that will make many good things permanent. If you're new here, this show is about one simple idea, week after week. Government should stay out of our lives. It should leave us alone. Our coalition includes everybody who wants to be left alone by the government: taxpayers, gun owners, homeschoolers, people who care about religious liberty, people who simply want to go to work and run their own lives. Today we're joined by James, Mike, and Andrew, and we're going to be talking about, well, let's talk about some of the things in the bill. Mike, you first.
Sure. So last night we had the big reveal where Senate Finance revealed exactly what it is they're planning to do and changes they're going to make to the House-passed version of the bill.
So the House reported out how long ago?
Well, about a month ago now, almost, I think mid-May.
Okay. They passed their bill by one vote.
By one vote.
Now the Senate votes on something completely different.
Yeah, I think likely we'll have a timeline here. Possibly action as early as the end of next week, going into the weekend even, if votes go very long. Because
for the Senate to vote?
Right. Well, Democrats have the ability to do the vote-a-rama here, where it's essentially, you're going to see them have every amendment under the sun voted onto this bill, and that process alone will take quite some time.
Yeah, so they can't filibuster, but you can add unlimited amendments to the bill. They're going to use this as an opportunity to make Republicans stay really late. I had to work through a few of these as a Senate staffer in my previous life before I moved to the United States of America, I guess, or whatever, however you want to call it, down to
the good team.
The good team, off the hill. But it can go very late into the night, and it's basically forcing a bunch of votes on tough amendments that make bad headlines for Republicans. They can put them in attack ads in the next election. So that's what you're going to see. You're going to see them offering amendments to give ice cream and puppy dogs to everybody, and then daring Republicans to vote against that because it doesn't fit into one big, beautiful bill.
And did the Republicans do that back?
Yes. So when Democrats did reconciliation, there were a lot of amendments condemning defunding the police was a big one, I remember.
Republicans were actually successful because they forced a change to the bill with one of the amendments, which was essentially they were going to use the alternative minimum tax they did implement. It was going to hit a bunch of small businesses by going, essentially Democrat effort was to go after private equity. They then had to go and make a pretty significant carve out to the bill, and which they substituted with a further increase on small businesses declaring losses.
Exactly, but it's stuff like that. So sometimes you can win policy victories, especially when it's like at the time it was a 50-50 Senate, right? So, or was that for IRA or was for that?
That was for the Inflation Reduction Act.
Okay, well it's 51-49 Senate, so it's a very, very close. But well, actually no, I'm sorry, that was the 50-50 Senate because that was late 2022, wasn't it? Yeah. With that, you can, if you can pull one Democrat across. Now, with 53 Republicans, it's less likely that any of theirs will carry, but what you are going to see is stuff where they're going to try and, create nasty headlines for the Republicans who will be in cycle in 2026.
How many questions will they ask? How many votes will they hold?
We have, 53 seats for Republicans in the Senate right now?
I'm sorry. How many votes will there be in the next several nights?
Unknowable. It's going to be, it will go until 7 in the morning. They'll start voting at like 4 in the afternoon and they'll go all night.
All right, well, so let's start running through what's actually in the Senate's draft bill.
Yes.
So this is the Senate's version of their tax portion released by Senate Finance, led by Chairman Mike Crapo of Idaho. So the foremost, biggest change in this bill that we here at ATR are very happy of is permanent for the pro-growth cost recovery provisions. We've talked about this on the show before, but this is 100% expensing, also known as bonus depreciation. This is interest deductibility, research and development expensing. Grover, can you tell us a little bit about how important these provisions are?
Well, it's important to make them permanent because if you don't, every 2 years or 5 years, you have to re-vote them. That's what happened with the research and development tax credit. And whenever you wanted to re-vote it, the Democrats would go, oh, well, we'll vote with you on this if you give us X, Y, or Z. And so you get extorted every single time it comes up again. People can't make decisions. A businessman can't know what the depreciation schedule is going to look like for a new building, for new equipment, for hiring new people, because it could change in 2 years. permanence is one of those things where, according to our friends at the Tax Foundation, it dramatically increases. If growth was going to be 1.5%, this would take it up to 3%. That's a huge number.
That study from Tax Foundation showed that just going from 5 years, which is how long these provisions are extended in the House bill, to instead making them permanent, more than doubles the economic growth in this bill. Similarly, there's a great study from the Council of Economic Advisors at the White House, Trump's economic team with Kevin Hassett, that shows, compared to the scenario of the Trump tax cuts expiring, permanency for they don't even actually include interest deductibility, but just for R&D and for bonus depreciation, can increase household wages up to $2,600. And similarly, around the same numbers as the Tax Foundation, significant change in growth. I think it's about 0.7% added growth just from these provisions in the long run.
And you can imagine Democrats will go, had they come up with some way to give you a check for $2,600, they'd be very proud of themselves. But with a tax reduction and limits on what the government spends, we're able to say your income will go up $2,600. And that's every year. That's sustainable.
And an important political point here, too. Permanency for these provisions essentially means that we're making the entire 2017 Trump tax cuts permanent. This is what the president campaigned on.
Yep.
As the Treasury Secretary very forcefully said back in February, the president had a mandate for this, and this bill accomplishes that. So by doing this, we're making the 2017 Trump tax cuts permanent. I think that's a huge achievement.
It's a big help politically, too, to be able to say, I told you what I was going to do, and I did it.
Now, separate from the permanency for the major pro-growth provisions, there are a couple changes. I think some good ideas here that rein in some of the scoring around some of the Trump ideas that he campaigned on. So no tax for tips, for example. The Senate introduces a $25,000 cap, which we think is pretty generous. I know on the show we've talked before about the original text introduced by Senator Cruz, even during the campaign, actually had a $20,000 cap. So this is still a $5,000 increase from the original legislation we saw Republicans introduce on no tax for tips, but something that helps bring the score down a little bit. We saw they maintained the same cap for the auto loans provision, no interest payment on no taxable interest on the auto loans. They changed that provision slightly so that it does not apply to used cars, which I think is good, especially if the idea is you want to incentivize new manufacturing. No reason to apply it to used cars. So I think that's an improvement that keeps the score down. So some good cost-saving provisions there, I think. And then generally throughout the individual side of the tax code, the Senate favored permanency rather than short-term larger increases. So for example, on the standard deduction, that's made permanent. On the child tax credit, a big difference between the House and the Senate here. The House had a permanency for our current $2,000 child tax credit, but went to $2,500 temporarily for 4 years. The Senate instead goes to $2,200, just permanent forever. So no short-term, no expiration occurring, just $200 increase to child tax credit, made permanent.
Simpler, permanent.
And I think, Grover, you made this point too. That means for Republicans, you don't have to come back for this and negotiate with Democrats later. Can you talk a little bit about that?
Well, it's just that we've had to do that when Bush did his tax cuts that phased out starting in 5 years and at the end of 10 years. And you had to redo everything. And Obama came in and said, well, let's have 85% of it to continue. And there are any number of things that you could blackmail people into demanding if you had just the presidency or just the House or the Senate. And these days, the Republicans are more likely to hold the House and the Senate. Since 1994, when they became the party that wouldn't raise your taxes, they've won the House and the Senate more often than the Democrats have, 18 years compared to 6. So we should be very happy with the idea that we can get this done, make it permanent, and not allow ourselves to get blackmailed or held up because the Democrats temporarily have one house of the Congress and say, nope, we won't extend it unless you give us what we want.
And actually, you don't even need a full House. All you need is 41 votes in the Senate.
Yes, that's right. To hold things up. Yes, very important. And look, making it permanent allows everybody in the business community who's deciding whether to buy another truck, hire another person, build another shed, build another factory, make that decision a lot easier.
The bill also maintains a lot of the good ideas that we did see on the House side. So, for example, it has the same increase in repeal of the estate tax. So the exemption levels bumped up to $15 million. That made permanent, doesn't expire. We've seen Republicans have to deal with that provision sunsetting before. I think good to have the estate tax, the death tax, higher exemption levels made permanent.
And the House went first because in the Constitution, if it's a tax issue, the House moves first. But we should never think in this point that the House or the Senate has the better bill. They both have got very good things in their bills. They'll come to an agreement and make some final decisions. I'm pretty sure I'm going to be happy with what they pass.
And Grover, another thing I think you'll like here is something that Senator Tim Scott of South Carolina is a champion for. They do have the expanded opportunity zones made permanent in this, unlike the House bill.
Excellent. That was a good idea. What else we got?
Well, speaking of Senator Tim Scott, I want to introduce the newest member of our staff here at ATR, Andrew Gins, who just joined us. And he's going to talk a little bit about the banking title, which also came out at the end of last week. And there are a couple of really important provisions, some of which aren't getting that much coverage. Andrew.
Yeah, of course. Great to be here. So the Senate Banking Committee came out with their title, and they have some pretty interesting provisions that came out. So I think one is the Section 1071 rule. So that was a rule that the CFPB had been trying to put out for a while now, and this would essentially delay the implementation to 2034, which is very good. So to give some background, Section 1071 would essentially require data collection on small business lending for financial institutions. So it would basically require collection of pieces of data such as race, gender, and even census tracts. So a lot of it was compliance burden that banks and financial institutions were worried about, and the CFPB, in their analysis of the rule, said that the costs levied for financial institutions would range within millions of dollars or so. So that was a big concern. The other thing, too, is this is also a very good provision that Senate Banking came out with, is they decided to add a provision which would amend the Consumer Financial Protection Act and change the amount of funding that the CFPB could receive from 12% to 0% of the Federal Reserve's inflation-adjusted profits. So we think that this is really good because it's a great way to sort of weaken their sort of power and sort of overreach.
Okay, explain this to me. They go from 12% to 0%. That means, do they have no money at all? That seems stronger than weakening.
Well, it's a significant funding cut.
Where else would they get their money?
They can go by the normal appropriations process to request money from Congress.
Oh, they can go ask for the money from Congress like normal thieves.
Yes.
Okay.
Yeah. But so to give you an example of the extent to which they would be losing out in money, they spent over $750 million last fiscal year. And the amount of money that they received from the Federal Reserve last year was around $250 million. So this would definitely be it would have a very substantial impact on the way they operate.
How many people work for them if they have $750 million in a year?
Well, right now I think it's hardly anyone.
Yeah.
Everyone, but
Yeah.
But typically, I historically it was. It's in the hundreds, right?
Yeah.
I would say as well. I mean, the fact that they don't have to go through the normal appropriations process to get all of their funding, and that they're able to dip into the Federal Reserve's coffers, has insulated them from any effective oversight. Congress doesn't actually have any leverage over how they operate or how they behave, because if they threaten to cut their funding, they'll say, okay, well, we'll just go to the CFPB. And so the only limit they had was the 12% cap on their spending. So the House bill lowered it to 5%, but the Senate said that's not good enough. We're going to 0.
Will the House approve 0?
I hope so.
This is a big win. This is not getting enough attention.
It is not, and we'll see if it survives the bird bath, which we've talked about a little bit on the podcast. But basically, in order for a provision to remain in a reconciliation bill, it has to have a direct budgetary impact. It can't be a policy, and the budgetary impact cannot be incidental to a wider policy. It has to be a policy outcome incidental to a budgetary impact. To me, it sounds like this is a budgetary impact, but because it taps into authorizing statutes, it can get a little wonky. So we'll keep an eye on what the parliamentarian says, and if 0% is too far, maybe 5, maybe 2, maybe 1, could be a compromise between the houses. But definitely a great step towards restoring the rule of law to this rogue regulator.
Huge, very good.
And also, Andrew, sorry, there is on 1071, somebody has a bill to fully repeal this, right?
Yeah. So Roger Williams earlier this month put out a bill, HR 976, And that would kill the Section 1071 provision altogether. So that's something that we're also watching out for.
And if you would like to keep watching out for our content, take a moment to rate and review Leave Us Alone in your favorite podcast platform. It helps us reach more listeners who care about freedom. And don't forget to share this episode with friends who value liberty. Now, back to the discussion. So thank you, Andrew, for that update. I wanted to take us quickly through the commerce title, which is another big one that dropped last week as well. So in the House, the Energy and Commerce Committee handles the telecommunications and tech items, but they also handle Medicaid for reasons I still don't fully understand about committee jurisdictions that were decided some half century ago or more. But in the Senate, it's actually the Finance Committee that handles both taxation and all healthcare spending that derives from the Social Security Act, which I believe Medicaid is a part of that. So, Mike, you can correct me if I'm wrong on any of these points here, but basically, in the House, Energy and Commerce handles energy, it handles commerce, and it handles Medicaid. In the Senate, and Ways and Means handles tax. In the Senate, Finance handles tax, and they handle Social Security, Medicare, and Medicaid. So what we want to keep an eye out for on Energy and Commerce, because in Commerce in the Senate, it's actually the Commerce, Science, and Transportation Committee. 3 items of interest. One is the car tax.
So I was actually, here we go, talking about committee jurisdiction, was wrong about this, had to get corrected. Senate EPW actually had jurisdiction over the car tax portions of this. And Grover,
that's Environment and Public Works.
Correct.
Not to be confused with Energy and Natural Resources.
Now, Grover's going to learn good news in real time here.
Oh, good.
The car fee, which some have called the car tax, has actually fallen out of the bill. So to remind people on the House side, this was a provision that didn't really gain much attention until the House Transportation Infrastructure Committee was voting. They included a $20 national registration fee on gas-powered cars. I believe either $100 or $150 registration fee on hybrids and $200 on electric vehicles. It had backlash almost immediately to where the House amended it to strike the $20 fee for gas-powered cars, but maintain the fee on electric vehicles and hybrids. It's been reported today that the EPW bill has decided to just drop the fees altogether. I think this is a good idea because the obvious concern would be the second Democrats are ever back in power, they will, of course, apply this new fee to gas-powered cars. And we're seeing at the state level, I think a great example would be Virginia, where the Governor Youngkin, had made a priority of his to try to target Virginia's very stupid car tax for repeal. So the idea of implementing what essentially amounts to a national property tax on cars.
Yes. If they can do your cars, why not your house?
Very short-sighted idea.
And so what earthly reason would you have for imposing a fee to a tax on registering your car while at the same time we're trying to make car loans tax-free?
Well, I think that's the exact approach right there is, right, what is good tax policy is let's go repeal these stupid subsidies for electric vehicles that the Biden administration did that are far greater for taxpayers. $7,500 tax credits on $80,000 luxury cars.
Which are not, they are refundable tax credits, right? So they're basically subsidies.
And transferable. So let's go repeal those stupid things.
It's a tax credit, it's refundable, and it's transferable.
Yeah, so you had this
it's
unique...
kind of like cash.
A
lot like cash.
The very stupid thing that we saw happening, and just you talk about how the government picks winners and losers and creates terrible incentives, is that because the auto manufacturers, because the transferability of the credit, what was going on is these auto manufacturers were essentially giving the credits away to their own leasing departments. So you basically had manufacturers' leasing departments ordering a bunch of manufactured cars with the credits, completely destroying incentives for do people actually want electric vehicles or not?
Oh, for heaven's sakes. Okay, getting rid of the car tax, that goes back to Gilmore when he was the new governor in Virginia.
Yeah, so to be clear, we're getting rid of stupid ideas like the electric vehicle tax credit. That's great policy. And then also, we should not seek to create a new property tax on even certain types of electric vehicles.
But the best way to smother a bad idea is when it's in the crib.
Exactly.
And getting it early is better.
Absolutely. Just to wrap up on the commerce title. So we talked a lot about spectrum auctions. We don't need to relitigate all of that here today, but the House version that we'd spoken about in the past had 600 megahertz of spectrum on the market for the FCC to auction. Auction authority has expired about 3-4 years ago. under the leadership of Chairwoman Maria Cantwell on the Senate Commerce Committee, who has found every reason in the few years that we were fighting over exactly how to reauthorize spectrum auctions. She had a series of shifting justifications as to why we couldn't do it this way. First, it was she wanted more money for middle mile spending. Then it was she wanted to save the Affordable Connectivity Program. And now she's suddenly become a defense hawk in the last week because Chairman Cruz, the new chairman, has released a title that makes 800 megahertz of spectrum available for auction. And we will hopefully see that come true fruition. So two items on this, or two takeaways.
Yeah.
Don't take Maria Cantwell seriously when she says she's a defense hawk and opposes spectrum for whatever justification is closest at hand. And second, the Senate is auctioning more than the House. The timeline is a little bit longer to get it done. The House wanted it all done within 5 years, but with 600 megahertz, the Senate's doing 800 over 8 years. 500 of that is coming directly from the government and going into the hands of the private sector. So that's great. I mean, it's not a property right that they'll hold forever. It is a license that expires at a certain point, but this is great. It will help generate revenue to offset some of the other provisions of the bill without raising taxes. And it will encourage so much more innovation since the private sector, we know, can put this to better use than the government. The White House deserves credit for this. President Trump directly deserves credit for this. He was tweeting about it. But he has been on this train for 10 years, since he was first running for president. He directed DOD, go work with the Senate. You got to play nice. They always want to hoard whatever they can. He says, you're going to give up what you don't need, and we're going to get this into the hands of the private sector so we can encourage innovation. So that's a big win. And then the other commerce item I wanted to talk about is as we speak on the floor of the U.S. Senate that I'm just watching on my phone here, we are confirming, the Senate is confirming Olivia Trusty to be the new FCC commissioner. So the Federal Communications Commission will again have a quorum. She is somebody who we expect to do a great job in overseeing these auctions because they passed this bill and they reauthorize auctions, but there isn't a quorum of commissioners. They can't do anything about it. So we're grateful that the Senate is being responsible here and covering both sides of that equation. And then the last item I wanted to mention was that right after this vote, sorry, we're really doing this live for the first time we've done with this podcast. There's going to be a vote on the Genius Act that we've been talking about the last few weeks. Final passage in the
What
Senate.
is the Genius Act, and who's the genius they're talking about?
Well, the genius is Senator Haggerty from Tennessee, who is the leader here. But the Genius Act is a bill to establish definitions for stablecoins. These are cryptocurrencies that are pegged to the U.S. dollar or to commodities, but in this case, we're talking really about the ones that are pegged to the dollar.
That's what makes them stable.
Yes, exactly. So they're not like Bitcoin, which is its own commodity whose price will fluctuate based on the market. It's not Dogecoin, which is pegged to nothing and is a joke. This is something that is pegged to the US dollar that basically allows you to conduct transactions in the crypto sphere with a dollar, right? Instead of the Federal Reserve issuing a central bank digital currency to try and squeeze other cryptocurrencies out of the market as they would try and do. This enables enables banks to issue these coins.
This reform on crypto will pass both houses?
So it's going to pass the Senate tonight. It got 67 votes on cloture. There's a very, very similar bill in the House called the Stable Act. We're hoping a very stable genius will come out of this process, but there are a few snags that might hit on the House side where it's obviously very closely divided. We're going to see what we can get here. It was bipartisan last Congress, so hopefully they'll either take up and pass the Genius Act right away, or they will find some sort of compromise relatively quickly to get moving. I hope they would move on this as quickly as possible just because keeping up the momentum, getting the Genius Act through, and then following up with some more legislation as necessary to sort of iron out these other issues that may still be outstanding that the Genius Act doesn't directly address would probably be good practice because while you have this narrow window where serious legislation is happening before the August recess, hopefully they can get on top of it and get it done and dusted. And do we have the government doing something dumb you want to talk about?
Let's get to what we're trying to make our reoccurring segment here.
We're making it. We're not trying.
The government did what? Where we talk about some stupid regulation or law that the government passed, and that hopefully here at ATR we're trying to get done and having success doing. So want to highlight this week, because we have the Senate text now, want to highlight a great thing from the Biden administration, a great thing we're doing to undo a stupid idea from the Biden administration, and that is the 1099-K IRS reporting rule. This is the Venmo PayPal issue we've talked about before on the show that I'm sure folks have heard about. The Senate bill, like the House bill, fully restores the pre-Biden reporting requirements. So to jog people's memory here, during the American Rescue Plan Act, this was Biden's first major bill in office, the $1.9 trillion spending bill for the alleged COVID emergency in March of 2021. The only real revenue-raising provision in that bill, because the Biden administration thought that was the perfect time to crack down on people's Venmo and PayPal payments, which was about a $9 billion tax hike at the time. Then, of course, from the expected blowback from the public, the Biden administration continued delaying implementing their past rule with no legal authority to do so, just knew it would be politically unpopular, so they kept punting. Until, of course, when the Trump administration was set to come into office, they said it can take effect now. So this Senate text, like the House text, fully repeals this. The threshold had been lowered to anyone who had more than $600 in transactions on something like Venmo or PayPal. You'd have to now file a new 1099-K tax form. This would have hit about 20 to 30 million Americans who would have been receiving this taxpayer document for the first time.
You sell a motorcycle, you pay part of your rent in a group home. That counts?
You have to prove to the IRS that that's not income. I think a great example would be fantasy football managers. So you have a group of friends you do fantasy football with. You're the commissioner, you're the guy who collects Venmo payments from everyone. Well, it would have been on you to prove to the IRS that you didn't just go make a bunch of money, that you're just actually collecting the money.
Do you have a personal experience with this?
So this is fully repealed now. It goes all the way to $20,000, the new reporting requirements.
Oh, that's good.
And crucially, 200 transactions, which that captures someone who's operating like a business, not someone who, for example, if you're splitting rent with your roommate, you probably would have gone over that $600 transaction in a single month. So this, again, it gets back to operating like a business is pretty much the standard for why you would have to disclose to the IRS additional paperwork and go through all your transactions on Venmo and PayPal. So I think this is a massive improvement. This is something even the Biden IRS said they were not equipped to handle. So common sense to repeal it here. Good thing the Republicans in both the House and Senate in their tax bill are doing this.
Going to wrap it up here. So thanks a lot for joining us at today's episode of Leave Us Alone. Thank you for tuning in. If you found this discussion valuable, please rate, review, and/or share the podcast. It helps us reach more freedom-loving listeners. We'll be back next time with more insights on protecting your liberty. Until then, I'm Grover Norquist, reminding you to cherish your freedom and keep pushing for a government that simply leaves us alone.